Today, we're breaking down SECT, the Main Sector Rotation ETF, an actively managed fund designed to rotate across equity sectors based on macroeconomic and market fundamentals. Unlike passive sector ETFs that stay fully invested in a single area of the market, SECT takes a dynamic, tactical approach, aiming to outperform the S&P 500 while also limiting losses during periods of market decline. SECT is structured as a fund of funds, meaning it primarily invests in other ETFs rather than individual stocks. This allows the portfolio manager to quickly shift exposure between sectors, industries, and sub-industries without having to trade hundreds of individual securities. The strategy is driven by fundamental and macroeconomic analysis, not index tracking. The manager behind SECT evaluates factors such as economic growth expectations, inflation trends, interest rates, monetary policy, and broader capital market conditions. Based on this analysis, the fund allocates capital towards sectors that are believed to have stronger near-term price appreciation potential, while reducing or avoiding exposure to sectors that may be facing headwinds. While SECT generally focuses on U.S. large-cap equities, the fund is not strictly limited to that universe. Up to 20% of the portfolio can be invested in securities of any market capitalization or geographic region denominated in any currency. This flexibility allows the manager to seek opportunities outside traditional U.S. large caps when the macro environment supports it. Because of this active flexibility, SECT's sector exposure can change meaningfully over time. During periods of economic expansion, the fund may tilt towards cyclical sectors such as technology, industrials, or consumer discretionary. In more defensive environments, allocations may shift toward areas like healthcare, utilities, or consumer staples. The goal is not to predict short-term market moves, but to position the portfolio in alignment with prevailing economic trends. Another unique feature of SECT is that the fund may, from time to time, incorporate a covered call option writing strategy. This approach can generate additional income and potentially help reduce volatility, particularly during sideways or declining markets. However, writing covered calls can also limit upside during strong rallies, which is an important trade-off investors should understand. SECT's active approach means that results are highly dependent on manager's skill and macro forecasts. If the manager's economic outlook proves accurate, the fund may outperform broad market benchmarks. If those forecasts are off, performance can lag a simple index ETF. This makes SECT very different from passive S&P 500 funds where returns are driven primarily by overall market direction. From a portfolio construction standpoint, SECT is often used as a satellite holding rather than a core allocation. It may appeal to investors who want tactical sector exposure, downside-aware positioning, or an active complement to passive equity holdings. It is less suitable for investors who want predictable index-like behavior or minimal tracking error. The bottom line is this. SECT is an actively managed sector rotation ETF that seeks to adapt to changing economic conditions. Its flexible mandate, macro-driven strategy, and optional income component make it a distinctive tool for investors who believe active management can add value through market cycles. If you found this breakdown helpful, make sure to like the video, subscribe to the ETF Investor, and comment below. Do you prefer tactical sector rotation strategies like SECT? Or do you stick with passive index ETFs for your equity exposure?